Good morning, folks. Good morning, Hem from South Korea. Good morning, Medevi. How are you? Good morning, Mr. Sinha. Good morning, Mr. Panda. Good morning. Good morning, Ranjan. Good morning, Anurag. Akash, how are you? Naveen, good morning. No, gold and silver are going up. They're not going down. It seems. Hi, Jobin. Hi, Sachin. Good morning. Good morning. Good morning, Sachin from France. Hi, Chandrasekhar. Hi, Saikran from Qatar. We have a quite an international audience. We'll take up the queries once we get going. Format will remain same as monthly meets earlier. Discussion about the markets for a few minutes, and then we'll open for questions. We'll run it for an hour. You can ask questions about anything you like. I'll try to answer to the best of my ability. Good morning from Kashmir. Nice mix of regions we are having this morning. Must be cold there actually. Okay, just give me 1 more minute and then we will start. Madhavi, I'll just take your query. So momentum report for WI strategy. So momentum, when you see so let me give a background. So anybody who has not yet gone to the website for a momentum portfolio report. So we've done a utility which will give you a health checkup on your portfolio. So you can put in your stocks and the quantities, etc., and the email will shoot to you with the health checkup of your portfolio, telling you that you may be skewed in terms of concentration in certain stocks, or certain parts of your uh, stocks are not keeping up well with the momentum score. So each stock will give you momentum. Each portfolio report will have a momentum score for your portfolio. So you may be at 55, but most momentum portfolios may be at 80, so on and so forth. And it will also give you on the side for weekend investing strategies, what is that momentum score. So maybe to answer your question, the report has the momentum score for weekend investing strategies also, in case that is what you were asking. Thank you, Rohit. Uh, Thank you so much. We are trying to have sort of a learning process where we are learning along with you also. So every time my research team comes up with a topic, or I give them some topics, I am also learning, they are also learning, you are also learning. So I think it's a very nice learning process all through. Somewhere or the other in our back of our mind, some new knowledge is going, and that is, I think, a very good exercise, even if it doesn't have any immediate uh, returns as such, but in long term we will have uh, good returns because of this. So let's start. I think we have very good quorum for the meet. Um, The markets in the last 1 month are sort of flattish. Nifty has gone up by 2% in the last week, but let's go for the month at 1 second. So 1 month, yeah. So Nifty is virtually flat. We've recovered from some losses. Nifty 500, Nifty mid cap also. Nifty small cap has done 3%. Over the last 3 months, we are still negative. Nifty is yet to recover from the entire fall, but let's say over last 6 months, we are reasonably positive. 8% for 6 months is very nice, and for 1 year, of course, 17.9%. So this one thesis that is getting the narrative is becoming larger and larger is that we are in a bubble that you will keep hearing all the time. So if we see, like for instance, even 5-year annualized returns, 5-year annualized returns on Nifty is only 15%. Um, Over a significant long period of CAGR returns, Nifty may be around 12. So we are like, maybe 3.5% per year, more than that. So it's not so outlandishly in any bubble territory that we are 100% above where we should be. Over last 3-year period also, if I see 3-year period, I mean, Nifty is 13.42. So from large cap perspective, definitely there is no bubble formation. In mid cap and small cap, yes, you can say that in the last 5 years, you got 30% CAGR on small cap, 28%. So this is a bit extended, but I mean, this is also not like really out there. So from my perspective, I don't see there is a huge downside to the market. I mean, yes, 5-10% can happen anytime in extreme situations, some more also. But it's not like, we are sitting at 24,000, we should be at 16,000. That situation is not there. So from all those perspectives, this fear that market will crash tomorrow and, we will, I think a lot of social media and influencers have been calling for market crash, and just see what is happening. I mean, instead of going for narrative, just see what is happening. In last 1 week, when we had the news of GDP cracking, we had the news of RBI not cutting any rate where market was expecting. The auto numbers, the results that have been trickling in the last 1 month, also not nothing outlandish. I mean, poorer than expectation. Yet market is holding on. So market is giving you a signal that doesn't want to fall. There is FII selling. Last 1 month has been the biggest sell month for FII. Still, market is holding. So, would you rather believe the narrative, or would you believe the market price in front of you? So I think market looks like on a steady, strong base, and of course, it doesn't say that it cannot fall. If there is a global event, if there's a local event tomorrow, if this government says that, okay, we are going to reserve 80% uh, budget allocation towards this social causes, obviously market will tank. So it all depends on the developing situation. But as of now, whatever has been baked in, my personal feeling is that we don't have much to go on the downside. Worst case scenario I've mentioned several times is the election day bottom near 21,000 is probably the worst case scenario right now. So things are looking good. Sectors are rotating, and uh, the if we see the let me just also show you the sectors. So last 1 month has been about a evenly balanced view. We have IT and real estate really doing well. PSU banks have recovered a little bit. The worrying part is FMCG, I think, where FMCG stocks are having some growth issues. And if FMCG volumes and growth is not picking up, then it gradually impacts the entire country. So FMCG is the sort of dark spot in the otherwise decent market. I think a lot of new knowledge or information will also come in the next few months. So next few months are data and news headline heavy, in the sense that one, Trump is coming in, how he's going to react to this new ministry formation, cutting uh, putting tariffs on other countries, cutting subsidies, cutting maybe. And see, we may feel that that is their business, but if suppose Elon Musk says that I want to cut 1 trillion of spending from government IT projects, I mean our IT will go through the floor if that happens. We are also offering a lot of services to US government. So, sooner or later, if that happens and it percolates into the system, the pullback of the liquidity. If they are spending $6 trillion and they said, okay, this year we will reduce the deficit to 3 or 4, uh, then it is going to be troublesome for IT and some other sectors, where we are exporting. So this is one very big data heavy point that is coming in the next quarter, that is likely to impact not just the US market but global markets. And of course, we are heading towards the budget, which is less than 2 months away. And there were murmurs of this direct tax code, the way the government has been aligning their mindset to less of capitalist society, more of socialism. It seems like more and more is going to get taken away from those who can pay. So there is, I mean, in my mind, I am not expecting any bouquets to come from the finance ministry on 1st of February. And on the contrary, they may take away some of which what is left with you. So these are some of the larger concerns, but because of liquidity flows, because of domestic investor, the household savings that are coming into equity markets now, I think the boat is reasonably steady. And yesterday I was watching some international speakers who were amazed to see how India's market has done, despite not being where we would want to be in terms of growth and the stability that we've had. Uh, I think that should be giving a lot of comfort to investors, new investors also. I mean, I don't recall any period in my entire 30-year career where for 5 years you did not really have any major shakeout in the market while having 25-30% kind of returns. So we are in a extremely Goldilocks situation. We must see the context where we are coming from. And the context is that we've had 5 years of this sectors growing at 30%, 28% CAGR for 5 straight years. Usually, when you will have 5 such fantastic years, the next 5 years are not going to be very nice. That has been the history, and we've done some studies on that also. But it seems to be a sort of a changed world where money will continue to be pumped in, and hence inflation will also remain high. Interest rates will also not go down. Now, today again, there is some talk that Fed may think of raising interest rates again. uh, RBI governor has refused to cut rates. He still says that there is a case for inflation going higher, so I can't cut rates. So things are gradually becoming hawkish again instead of interest rates coming down. So more and more people will be driven to take on more risks, because when you have such high interest rates, high inflation, you will need to take more risks to beat the market, to beat inflation. And so markets should be doing all right from that perspective also. Um, so I want to delve more into the markets. We'll want to take more questions. Just this last slide here, that the momentum overview. I mean, we're still seeing IT, real estate, and PSU banks, which are sort of leading the momentum scores here. IT, as I said, it is very, very dependent upon the US outcome now. But the way it is going, it seems like IT is the place to find opportunities here. Real estate, every now and then people say real estate is a bubble, it will not last, this, that. But for 5 years now, real estate has run at 30%. And on ground also, there is no let up on real estate. So I think the markets, and by its very nature of, sensing what is happening, this high inflation, high interest rate scenario, I think more and more money is going into real estate also, and that is fueling that rally very well. So with this, let me just open up for questions. So I'll take the questions, whatever uh, time period I have, and I'll try to do as many as I can. So send in your questions, and I will take them one on one. Okay. So 11:14. Let me just take questions from here. Okay. Girish Patil says advice for people who miss the dip. So you have not missed anything. I mean, what have you missed? If we see the chart, I mean, Nifty is up like 1,000 points from the bottom, 4%. So nothing has been missed. Don't think in this way that actually don't think short term. If you are going to make money in the market, don't think short term, because 99% people will not make money in the short term. So if you want to make money, think long term. And when you will think long term, I mean, there is no dip. You just go and see the long term chart of Nifty and see what dip you are able to see. You'll not be able to see any dip. So don't worry about all that. Faye says, thank you for doing these live videos. What is your opinion on Paytm from here, down or up? So I can't give direct stock advice, but in general, I would say Paytm trends are upwards. I think a couple of our strategies also hold it. Uh, Whether you should buy or not, that you need to go ask your advisor. Do you have an indication of post-tax CAGR for all cap and ATH2? No, I don't have that handy, but you can go to the Weekend Investing Hub or weekendinvesting.smallcase.com and see the CAGR, and assume that all transactions are short term. So you reduce the CAGR by 20% and you'll get the post-tax return. That is as simple as that. Although it is not the case that all are short term, but even if you assume that, you will have that number. Rohit Agarwal says, curious to know what your typical day looks like, both on and off market. So I think my I'll quickly do this because I don't know how many people really want this. So I'm at the desk at 9:30. I am off the desk by about 6. During the day, I like to read about the markets, about what's happening in the world. I tweet. I also do research on trends. Sometimes I also like to read about other asset classes other than the markets. So I don't look around for tinkering our existing strategies or curve fitting them. I don't do all that. So my week is not really uh, into how I should improve these performances or results. My week is more about if somebody is having so a lot of user queries are there, some of which are handled by my team, some which are more technical come to me. Um, what else? I mean, I have a reasonably balanced week. Uh, I have a hour of exercise in the morning, 5 kilometers of walk every day. I like to do that, and then I'm an early sleeper. That's about it for my. Uh, any plans for US weekly strategy, says Abhishek. So we have one US weekly strategy that has been running for almost 14 months now. It's doing well. It's a free educational strategy. It is available on the Weekend Investing app. It runs on the top 100 US stocks. If you are a weekend investor, you can access that strategy. Um, as and when regulations will allow us to offer it as a product, we will do that. But right now, there are a lot of regulatory here around that. So we can't offer it as a product, but maybe in 2025 that may happen. So as soon as that will happen, we will certainly have one or two US strategies available for your use. Rahul says outlook on gold and silver. So I think both are consolidating right now for the last few weeks. Gold has done very, very well. Let me open up the chart also for your better viewing. 1 second. So I hope you can see my screen. So gold has really, done very well this year. Since the beginning of the year, we are up almost 30%. So, whenever gold will do 30 to 50% kind of moves, it will consolidate for a while. So we may get some consolidation, but the trend is very nicely up. I mean, we are above 200 DMA nicely. Everything is fine. I mean, the point to note here is that this consolidation that we had from August, June, July 20 to 24. So 4 years of this ranged consolidation happened, and we've just broken out of that. So there may be a immediate consolidation here, but we are going higher. I mean, that is my belief that we are going much, much higher. And this range also, was at the same point where we had reached in August 11. So actually speaking in dollar terms, over the last 13, 14 years, we are still up only 35%. So it is nothing really. I mean, we can easily go $4,000, 5,000, even more than that. So, I mean, if you see the very long-term picture, there are three phases of gold move. So, first phase that happened here, then there's a long consolidation for the second phase, that long consolidation, and now we are in the third phase. And each phase is like multiple times where we were. So I don't think we will stop anytime soon. But it will also depend upon these new policies. If Trump comes in and says, that we are going to have austerity and a lot of money printing will stop, then gold may drop for some time. But overall, I see no reason why gold will not continue to perform. Ayush says when to be 100% deployed and when to sit in cash and how much in discretionary form can we decide as per EMA second. So it all, I think, Ayush, depends upon your design of your overall strategy. Now, a lot of discretionary traders, investors, will go from 100% deployment to 100% cash basis, their exits from their uh, positions, which are probably having very tight stops, etc. EMAs can be good, but EMAs will usually have a lot of whiplash. So if you plot any EMA, 50 EMA, 200-day EMA, a lot of times you will be going in and out, and that over a period of time becomes very exhausting. And after some time, you give up. I mean, if you get a long patch of, a flattish EMA, and then you're going long, stop loss, long, stop loss, long, stop loss, it's very, very taxing. So you need to see what is the sort of your uh, liking for such things. I mean, some people are very patient, some people are not so patient, some people are happy with, let's say, 15-20%, some people want 40% returns every year. So I think you will need to see what is your need and then design it accordingly. I think if you are an aggressive trader, investor, and you're looking for big gains, you should look for maybe, strategies which will pyramid up positions, higher risks, but much higher returns also. If you are more you know conservative investors, or you don't want to have very high risks, then you can have strategies which have low churn, which may uh, which may not have a lot of activity on a day-to-day basis. So again, it will all depend upon. I don't know if I answered your question, but it'll sort of depend upon you only. Amrish says many investors find it hard to stick to rule-based strategies during turbulent times. What psychological traits do you recommend to overcome this challenge? Just don't look at the markets all day long. If market is falling and you have invested in a rule-based strategy, which says that I will be rebalancing every 1 month. Now you are on 7th December, market is coming down. Next rebalance is on 1st January. You can't spend that 3 weeks worrying about your portfolio. I mean, either you get out of it and do something that will give you peace and good sleep, but you can't be worrying about your portfolio and doing all kinds of things, getting in, getting out, because you think that markets will you will be able to find them lower and invest later on. So I think it's like you go and sit in a train or a bus or aircraft, and then you don't worry about how the pilot is flying the plane, right? I mean, when you sit in the plane, are you worried that उसने वो landing gear down किया, अब किया कि नहीं किया? You're not worried, right? I mean, you've left it to him कि भाई देखा जाएगा. So then same thing you do here. I mean, if you're following a strategy, don't put your brain to it. You have to trust your driver, your advisor, whoever it is, and let them drive. If you don't want anybody to drive you, then you drive yourself. And if you find that you don't do too many accidents, you should drive yourself. So that's how I would feel. I mean, uh, this sense of control that a lot of folks don't want to give. See, why people want to do direct investing? Because they feel that if I give my money to somebody else or if I follow somebody else, they will, ruin my money and I will be able to do a better job. But they never feel the same about when they go to a doctor. They never feel the same about when they go to see some other consultant in some other expertise, because there they know that they can't do it themselves. Here, this feeling is there that I can do it myself. So one should try. If one is able to do, very good. If one is not able to do, then you give to somebody and forget about it and trust the system. The trust factor is something that you need to develop, and that can come over time. You can, if you have 100 rupees, you give 10 rupees and see how it goes. Then you give 20, then you give 30, then you give 40. Gradually, your trust will develop over that. Night Fury says, Chandrasekhar says, how is survivorship bias data impact return if my strategy picks stocks from all NSE all listed stocks? So if I am reading this right, you are doing some back testing based on current NSE all listed stock, and your result today for the period gone by is going to be very, very impacted by survivorship bias. What is survivorship bias data? A lot of stocks that were earlier, let's say, in the index are not there today. Lot of stocks which are there in the index today were not there earlier. So if, let's say, you did a back test uh, from, let's say, last 5 years, last 10 years, then stocks like maybe JP Group, maybe India Bulls, a lot of stocks which have gone down in the last decade um, would not be there in your current set. So if you have your current indices, let's say Nifty 500 or CNX 200 or whatever you may choose, uh, those stocks may not be there. But if you take all the stocks, and if your data provider can give you the data which even the stocks that have been eliminated are there in your data set. So when you're running your study in the last 7 years, 10 years, if it had the stocks which were existing at that time, even though they may not be existing today, then you're fine. But if you're only using the stocks which are existing today and running a study 10 years back, then there will be a huge uh, impact of this bias in your outcome, and that is not reflecting the real market at all. So if you take, let's say, today's Nifty 50 components and run a 10-year study, the results will be beautiful because these 50 stocks have done the best, and hence they are in Nifty today. But 10 years back, more than half of these stocks were not in the Nifty. The stocks that were there have been burnt badly. So your results will not show the true picture. So hence the need for survivorship bias data, which unfortunately there is no data provider in India which provides any survivorship data, survivorship free bias data, and you have to build yourself. As far as I know, there isn't one, but if you find somebody who offers that kind of data, please do let me know also. Thank you, Girish. Uh, Himanshu says, I work for the big four. Congratulations. I want to invest in Smallcase, but had to sell because of risk and independence regulation. How should I proceed? So I think a lot of consulting folks from the big four invest in Smallcases. I don't see them having any issues. Let me know what is your specific issue. If there is a specific issue regarding a particular company that you cannot invest in, let's say you have a client and that client is listed and the client is also, that listed company is also part of a portfolio. Most people, because uh, it's a portfolio that advice that you're getting, it's not really direct investing from that perspective, although it can be argued. So let me know what is your issue, and we'll try to get some opinion on that. Mayank says, do you think Nasdaq PE of 50 is very high and US market may crash, considering US planning to reduce spending from 6 to 4 trillion? So PE ratio is I think the worst uh, uh, metric to really gauge what the market is doing, because if it goes from PE 50 to 60, you'll get a 20% jump. Uh, so yes, from a historical perspective, price earnings in the US markets in general are also very high, not just Nasdaq. But this time, what is being said is that earnings growth, especially in the top 10 companies, has kept very good pace with the price moves. So if you see the chart of Nvidia and even Apple, um, Amazon, all these companies have reasonable appreciation in terms of earnings as well. So US market, of course, is historically much higher than the average, but you must understand this, that historical means nothing. I mean, if in the previous decade price earnings was 20, the next decade price earnings could be 40. Who stops? I mean, who is going to decide what price earnings is a decent price earnings to? See, this is the problem I have with all this way of thinking. That earlier price earning was 18 and now it is 25, and hence we must go down to 18. But why we have to go down to 18? Why not the benchmark become 24 from here onwards? Because you have to understand that the base money is expanding like crazy. If I were to plot here the money supply uh, in the US, um, this is how fast the money is growing. The amount of money in the system, it is just going. Uh, if I see regular chart, you just see from 2020, from 14 15 trillion, we are at 21 trillion. So the base money is going up. If there is more money, everything has to be valued higher, because the value of money itself is dying. So if there was fixed amount of money in the system, then I would agree to the fact that yes, earlier it was so much, now it is here, so it should go back for fair valuation. But when the base of the money itself is growing like bananas, then it could be anything. 10 years from now, maybe 50 PE will be historical PE, and market may be trading at 100 PE. So, I mean, while logically it makes no sense that this can be sustained, but how logical is it that your entire money base is also growing at that pace? So it's a completely broken system. Yes, at some point we will crash for sure. Where is that point? Is it tomorrow? Is it 2 years later? Is it 10 years later? Is it 20 years later? Nobody can say. So don't worry about that. Just keep yourself protected by having adequate insurance, hedge, whatever you may call it, diversification, and ride along. That's the best you can do. If you keep worrying about PE ratio, then people have not been able to get into the Indian markets from 2013. Let me show you that chart on this note. There is one very nice site in PE ratio. You can refer to this. Let me just open this. Give me a second. Yeah, ratio. I hope you can see my screen. So this is Nifty PE ratio.com. They track the PE ratios. And you can see here, we are currently at 22 times price earning forward. And there was some change in the P ratio calculation earlier. Now you can see earlier it used to play in this range. And now since 2015-16, the range has changed. Can you see? I mean, the chart was mostly in this region below 20. And now the bottom is at near 20. And higher, of course, uh, that may be due to that standalone and consolidated thing. But you can see in this chart that these in 2001, 2, 3, you were at 11 times, 13 times, 14 times. These 11, 12, 13 have not come in the last decade. You see all the numbers here from 2014, 13, 14 onwards. You will not see anything less than 20. And here you are able to see 11, 12, 14, 16, 12, 13, 15 for many years together. So if somebody said that I will buy Nifty at 12 times forward and I will sell Nifty at 50 times forward, suppose that was a system somebody was using. Then post 2008, there has never been a time where Nifty went to 12 times. So वो तो 15 years से somebody would be waiting, I'll buy Nifty at 12 times. The market has shifted. The entire PE base has shifted, and who knows, it may shift more. If more money printing will happen, I mean, everything will go up, and so take PE with a pinch of salt. But yes, US market can crash. We can also crash. Crash will happen sometime or the other. You can say every decade you will have one crash. You assume that you will have one crash. Now you plan for it, right? That's the best way to think about it. To think that you will never have a crash is foolish. So you plan that there is going to be a crash every decade. I will lose money, but then I will make a lot of money also. And so I have to make sure that I don't lose all my money. And when the resurgence comes, then I will make a lot of money. That is the plan you should be having. So it should be realistic. Less like, you have a car, you keep it for 10 years. If you assume that it will never get scratched, nobody will ever bump into you. You will never bump into anybody. I mean, it doesn't happen, as not in NCR at least. So you keep in your mind that I've taken insurance. If somebody crashes into my car, I'll get it repaired and move on with my life. So this is exactly how you should approach the market. Properly asset allocated, properly hedged, insurance is there. Now I'm riding the wave. If something happens, that's okay. Because after that crash, a 10x move will again come. So the idea should be that you have a strategy which may collapse once, but then will give you the kind of returns which will take it much higher than where you were. That is the whole idea. Saikaran says you are a great chart reader. Some sources for learning chart pattern. I don't know if I'm a great chart reader or not, but I like to read charts, and it is like a fun passion that I have. And I have not learned from anything. In fact, I have several books, but I've never read them on charts. I'm just observing charts and trying to derive inferences from that. So I think just watching a lot of charts and chart patterns will give you that sense over a period of time. But I think a book by Maggie and what was the name? That is supposed to be the Bible for chart reading. It's an expensive book. Somebody gifted it to me, but I haven't read it through. So that gives me a good idea. I should. Okay. VK says Anandita is making fabulous videos. Glad to see new generation. Thank you so much, sir. She'll be very happy to hear this. For those who don't know, Anandita is my daughter, and she had joined Weekend Investing a year and a half back, post her uh, business degree from NUS, etc. So she is now learning the ropes of the business. She's also heading several parts of the business, uh, and hopefully she'll take more and more responsibility going forward. So you will see more and more of her creations going forward. Um, Haim says, why HNI strategies are restricted to 1 crore limit? I don't think 1 crore qualifies for HNI in the current tax and inflation regime. So there is a reason why we have restrictions for most strategies, not just HNI, but for others also. The reason is that Smallcase as a platform is designed only for market-driven orders. So when you put in your order, it goes in as a market order. It does not go as a limit order. Now, when you send market orders, it will go to the best. Let's say you're buying, you're doing a rebalance of whatever amount. Let's say you have 5 crores of portfolio, and let's say 20% of the portfolio is changing. So 1 crore buy order will go into the system over, say, let's say 4 stocks, right? So each order will be 25 lakhs rupees worth, and you are hitting the market as a market buyer meaning buy at whatever market offers you, and the seller is could be either very near the market price or could be a bit away depending upon the stock, and there could be slippages because of this, and you are just one of them. Let's say there are 1000 of such investors, so then each point will be like 25 crores of order, right? uh, which no, even if you were to put 25 crores of market order on Reliance, even that will move for some time. So this is why we are constrained in terms of having too much money running on these strategies, and we limit that. We sometimes even close strategies when we find that significant AUM has gone into a particular strategy. So that's the reason for limiting this. We are hopeful that we may be able to come up with some PMS, AIF, something in the future, because a lot of folks want that we don't restrict them to 30 lakhs, 1 crore, whatever may be the reason. So I hope that answers your question. Um, Praveen says some of the stocks and the strategies have done very well. Should we keep a rule of exit after a stock does really well, as most of the time we exit these not at the highest profit? So if you have 100 transactions in a year, 50 will go right, 50 will go wrong. That is the sort of average outcome. The 50 that go right should perform very well. The 50 that go wrong will take some profit away, some losses there will be there. If we preempt how a profitable stock should be exited, then maybe we will lose some part of that profit. If we preempt at every point that no, this is enough. So what is the usual way? You allow the stock to go up, and then when it doesn't go up any further, what will it do? Either it will go flat or it will start to come down. So if it stays flat for significant period of time, you will exit. Our strategies will exit. If it starts to come down, it will exit. But if it keeps going up, it will not exit. It will continue to go. So whenever you will find that a stock has topped and then comes down, some part of the profits will be given up. And that is part of the strategy. That is acceptable. Sometimes all the profits are given up. So maybe some stock will go up very fast and then it just collapses. So you may give up all of it. But that's okay. I mean, as long as the portfolio overall over a significant period of time is giving you the returns that it was supposed to give, then that's fine. Why should we, try to maximize each stock entry or exit. And this actually, this thought itself that I should not lose anything is a wrong thought, because you cannot buy at the bottoms and sell at the tops all the time. It will happen by coincidence sometime, but only God can do that, that buy at the bottom most every time and sell at the top. Nobody else can do it. So there's no point even trying to do that. In trying to time the exit, most people will miss out huge rallies. You know, some stock has gone from 100 to 500, बहुत हो गया, let's sell it off. वो 5,000 जा रहा था. So don't do all that, in my view. If you want to put a additional layer of rules on top of the strategy, which you think can improve your results, and you have the time and the effort and the knowledge to do that, most certainly, please do that. But we will not advise anybody to do that, because the design of the strategy is sufficient enough to make sure that you make money out of that. Lok's Deepa says, is it a good time to take leverage? So I think any time is a good time to take leverage. I mean, you should be knowing how to make money out of leverage. I mean, even September, October, when market was falling from October, November, that was also a good time to take leverage and short the hell out of the market, if one were to do that. But if you are saying that should I borrow money to invest in long-term investing, that is something that I don't think should be done, because markets can be irrationally high or irrationally low for long periods of time. As history has told us, it has not happened in the last 4 or 5 years, but history says that 4 or 5 years is not, the entire history of the world. So if you are trading, if you are good at finding opportunities, anytime is a good time to take leverage. Sorry. Dheeraj says top 20 momentum stock find. I used stock edge, each stock 25,000, buy total 5 lakh capital and top 20. I Let me know what is the question. This seems like a strategy that you're telling me. Let me know the question. So Vishal, I have just answered this question. We will definitely launch US-based paid products once we have a regulatory clearance on that, which should come in the next year, I think. Jobin says, what are your thoughts on total market index funds? Would they be better alternative to holding separate large cap, mid cap, and small cap mutual funds? So I am not really a mutual fund specialist. I don't know much about them. I think that mutual funds is for lazy money. By lazy money, I'm not trying to deride anybody, but it's like, you give your money to somebody and you say that you give me somewhere near market returns and I'll be happy with that. So that kind of money is good for the index funds or for other mutual funds. But I think some involvement of yours in trying to improve on that is where the few percentage of alpha that one can generate comes through. So maybe by your own self, or maybe by following some strategy or something like that. So the idea here is that uh, index funds, the US experience has been that index funds are difficult to beat, but in India that is not the case so far. Uh, so my sense is that if your portfolio is large enough that you can segregate the segments, do segregate them, because each segment has a specialized manager or a specialized portfolio could be there, whereas total market index funds will be just a khichdi of everything. So that's my thought on that. Is buying SGB a good idea? Yes, if you are able to get SGB below fair value. Amit Wani had created a SGB calculator where you can calculate the fair value We've given the link several times. You can also Google Amit Wani SGB calculator. You'll get it there. If you are able to get it below the fair price, it's still a good buy because you will still get tax-free maturity. You will still get 2.5% additional gains. So that is where the opportunity still is. Okay. Kalpen says, I am a weekend investor since 4 years. Great admirer of your recommendations for gold. I am planning to invest large amount in lump sum as saving account. NG50. So NG50, for those who don't know, is a free strategy which invests in Nifty ETF and gold ETF. It has done well. It has done about double-digit returns every year. So it's a good alternative to the money that you don't need in the long term, in the short term, sorry. So instead of parking your money in a savings account, in case you want to have some risk on that money, but not really, that is a good place to be because usually it'll be a good balance in terms of gold and Nifty. So you could do that. You could do that, but do take advice from your financial advisor on this. Vivek says, why does SEBI focus more on preventing retail and option trading while allowing market manipulation by HFT firms and algos? It's a good question. HFT firms and algos are run by large firms who are established, who have capability of managing that those algos, those co-location servers, and so all the paraphernalia that goes along with it. Whereas when we say retail, there could be fantastic, sophisticated retail traders, but then there'll be a lot of others who have no knowledge about this at all. And to protect them from, elements, middlemen who will lure them with all kinds of uh, offers, that is where the heavy hand on regulation comes through, and it prevents genuine traders also from having that kind of facility which maybe larger firms have. So that is sort of the way the world works, not just in India but everywhere, I think. Snehmoy Samantha says, how to deploy lump sum 30% of my corpus I have right now. So my suggestion is that because you are looking at a very long-term outcome of this, there should be no reason to jump in with lump sums. Just spread out your money over a period of time, maybe 1 year, 1.5 years, 9 months. Gradually ease into the market. What it does is that it prevents you from being in a situation where you entered with a lump sum and the market collapsed. That may be the sort of unluckiest point for you, that in the entire decade market had to collapse once, and that was the moment when it did. So just to prevent that trauma, if it happens, you will never be able to invest in your life again. So just to prevent that situation, even at the cost of reduced returns, you want to go in gradually. As you go in gradually, maybe the initial investments that you do will make some returns by the time more and more money comes in, and that will give you more confidence also. So it's just a very safe way of entering the market. Of course, if market, let's say, is going from 24,000 to 30,000 in the next 1 year, for instance, then lump sum is the best right now. But nobody can really predict that, right? So the question is, will you be okay if you put in your corpus today as lump sum and it goes down 30% and then the market revives? If you're okay with that, then lump sum is fine. But if you are not okay with losing a lot of money suddenly, then don't do that. That would be my sort of thought. Prakash says, any other option to hedge apart from gold in Indian market? So typical asset classes are there. There are alternative asset classes now. There are all kinds of funds are available who are investing in unlisted stocks. uh, REITs are there, or you could go direct real estate. Uh, you could also go into US stocks. So a lot of options are there besides Indian stocks to put money into. Some people will buy art and those kind of things also. Um, Akshat says, do you have some regime detection model to avoid years like 2016 and 18? Basically shifting from momentum to low vol or gold during that time. No, we don't do a dynamic allocation of shift, but the strategies will go to cash whenever they find momentum getting lost, or they will move into stronger or more defensive kind of stocks. Usually, regime detection is late, even in any model that you create. Regime detection will, why will a regime detection happen? Only when something is changing, and when that thing is changing, you are anyways getting out of those stocks and getting going into cash or things like that. So I see a little sort of merit in trying to sort of have a pre-detection of sorts, um, uh, and just because, see, the basic thesis that in my mind at least is that nobody really knows how quickly regime change will happen and then revert back also. So it may result in a lot of whiplash as well. So a lot of these models have to be done very, very carefully so that uh, you don't get into a situation where what has not happened in the last 20, 30 years, if those kind of situations start to happen, then what will your model do? So it needs to be taking care of that as well. Amit Navi says, better way to average up, should I book the dip or book profit and make fresh entry? Let me understand this. Better way to average up. So if you are asking that, should you average up as price goes up? Yes, I mean, that is the better way. It is also a more sophisticated position size handling method, which a lot of folks are not able to do. A lot of folks uh, lose a lot of money pyramiding up positions because they're not able to control the risk once the position becomes large. So it is better way. Professionals do that. If you are able to do that, that's fantastic. Uh, this other question is, should I buy the dip or book profit and make fresh entry? So again, it will depend upon the design of your strategy. Some strategies which may not be momentum in nature will definitely be buying the dip. Momentum strategies probably will, or trending strategies will probably get out on dips and make fresh entry once again once markets go up. Okay. Mallikarjun says, what is your forecast on FMCG? So I think FMCG has been a very evergreen kind of a sector for the last 2 decades. And periodically you see cyclical slowdowns in that sector. And over a period of time, it sort of self-corrects itself. I mean, that has been the experience in the Indian market. So to say that FMCG will not perform for a long period of time, I don't think that will happen. But yes, the kind of returns that people have enjoyed in the previous decade maybe not possible, because even after the slowdown, stocks are still sitting at very, very high valuations, and that is a concern for a lot of investors. Kotak says, can you give brief intro to your small case which has turned 6? So we have a video that is out there. We can share that with you. Basically, you're talking about all cap strategy, which is a strategy that uh, invests in large, mid, and small caps and invests in very, very liquid stocks. And it of course chases stocks that are in momentum. It's very low churn strategy, has done well over the last 5 6 years that it has been there. It is also one of our biggest uh, and most loved strategies by investors. uh, Giri says, am I evergreen CAGR, is that coming more from gold as it has stocks with losses, example Paytm? So I think Paytm is not really in loss now, and in any case, uh, this year the allocation from gold has given good returns to Evergreen CAGR. Overall, also I think Evergreen. Let me just show you 1 second. So you can always go to weekendinvesting.com and go to analytics page. Let me just show you that. What is that? Share screen. I hope you can see my screen. So you can always go to weekendinvesting.com, go to analytics. You can say compare strategies. And here all the data is available. So you can go to Evergreen and compare it to, let's say, CNX 200, based on which it is the 200 stocks are CNX 200, and 1 year is what we are comparing. Okay, so no problem here. Yes. This utility is down. So last 1 year, I would say, let me try again. Okay, we'll get this check, but you can also go here, for instance, weekendinvesting.smallcase.com. You can go to Evergreen. Let's see 1 year performance. So you can see here that 1 year performance here on Evergreen is 54%. The large cap performance in the same time period is 21%. So a significant part of the gold allocation, which is about 25% allocation, would have given maybe 20% of this return, but most of it is from stocks only. And for specific stock, I think Paytm is doing quite well. Let me just also show you that chart. Paytm. Paytm is has been recovering very, very rapidly, and I think people are surprised by how Paytm has been doing. So yeah, this is Paytm, and I don't see any reason why we should be in loss here. So I've run out of time. I'm sorry if I have not been able to take more questions. I hope some queries got resolved, some new information and knowledge was transferred. Thank you so much for having your presence in these monthly videos. It gives us a great opportunity to connect with you, and of course some questions get resolved. If there is any burning question that is requiring our assistance, please drop us a line. You can drop an email to support@weekendinvesting.com. You can send mail to me, alok@weekendinvesting.com, and we'll take it up. So that's the end of today's session. Thank you so much for joining, and have a great weekend. Bye bye.